Today, as you know, the board decided to raise the cash rate by 25 basis points. Since the start of the year, the cash rate has now been increased by 75 basis points. These increases have been necessary to tighten financial conditions and slow growth in demand in the economy to ensure we get on top of inflation. Inflation hurts all Australians because it eats away at the purchasing power of our money. Inflation in Australia was already too high before the recent conflict in the Middle East began. The most recent data have confirmed that some of the increase in inflation was being generated by economy-wide capacity pressures, including ongoing tightness in the labour market. Developments in the Middle East remain highly uncertain, but under a wide range of possible scenarios, the conflict adds to global and domestic inflation. The shock to oil and some other commodity prices has worsened the trade-off between inflation and growth. Already we've seen a sharp increase in fuel and related commodity prices, and this is already feeding through to inflation. The recent increases in interest rates will have no impact on this. What these increases do, however, is help to contain the domestic inflationary pressures after the inflation due to oil and related commodity prices eases. Now, I understand this is a really difficult time for households who are already facing higher fuel prices and other cost of living pressures, but we must get on top of inflation now so that it doesn't get away from us. We're already seeing that in many firms that are facing cost pressures, they're looking to increase prices of their goods and services. If left unchecked, higher costs get embedded into price and wage setting decisions. These second-round effects could lead to even higher and persistent inflation, and if so, would require even more tightening in monetary policy to get inflation under control. We've already seen expectations for inflation over the next year or so increase, and we need to ensure that this does not lead to higher inflation expectations over the longer term. When inflation is already too high and the economy facing capacity pressures, it doesn't take much additional spending to make the job of returning inflation to target more challenging. This means spending will need to grow more slowly for a time to help restore the balance between demand and supply. The recent cash rate increases have been to address the excess demand that existed in the economy prior to the Middle East conflict. Higher fuel prices by themselves will not address this. The board now judges the level of the cash rate to be a bit restrictive, which will help to address the risk that inflation will be higher and more persistent once the current prices shock passes through the economy. This gives the board space to see how the conflict plays out and the response of Australian households and businesses to the shock. The board remains focused on returning inflation to target. The board will continue to be driven by the incoming data. We will monitor the situation overseas and how it's affecting the Australian economy. We'll also continue to monitor the incoming Australian data and assess the implications for the outlook for domestic spending and inflation. So thank you, and I'm happy to take your questions.
Thanks, Governor. Swati Pandey from Bloomberg News. Just wanted to understand, based on what you've just said, are you on a wait-and-watch mode from here on? Because you tried to imply that the current policy settings seem to be appropriate to bring inflation to target.
So wait and watch is probably the wrong term, but I think the board now feels that the initial conditions that we were trying to address before the war started, which was a space of excess demand, and we needed to get demand to slow so that it was putting less pressure on inflation. We feel we're now in a position where we've got space to be alert now to both sides of the risks to inflation and the potential risks to the downside if the war continues.
Matt Cranston from The Australian. The Australian newspaper today reported that the government is going to inject a big bunch of stimulus into the economy. Other governments are also got similar policies on different things. And in your statement on monetary policy today, you say, you sort of raise this point, you say governments may consider policies to support households and businesses. So my question is, I'm not looking for your advice to government. I know not to ask you for that, but can you explain to Australians how these sort of policies may help or hinder your fight against inflation.
Sure.
And, more importantly, your fight against inflation expectations.
Yeah, sure. So, taking off where I finished with Swati, we have a situation in Australia prior to the war where we had demand above supply. The ability of the economy to supply the goods and services that were being demanded in total, including by government and by the private sector, was outstripping the ability of the economy to supply it. That's why inflation was rising. So by definition, if we are increasing interest rates, what we are trying to do is slow growth in demand, and that hits the private sector typically, consumption, investment, those sorts of things. To the extent that the government is demanding goods and services of the economy, so in the variety of ways that they do, whether it's direct expenditure or giving money to households to spend on goods and services in the private sector, that adds to demand. Now, if we're sitting at a position where we are constrained, the economy, productivity isn't growing very quickly, we think the potential growth's around about 2% a year, that means that in order to close that gap, we have to have demand growing by less than 2% to close that gap. And both private sector and public sector have to contribute to that. So all I'm saying is that the extent to which government make up the shortfalls for households by giving them more money, it makes it harder to dampen demand. The bottom line, though, on all of this is this shock it's a real income shock for Australia and the world. Australians are poorer because of this shock to oil prices and energy prices and all the other commodity prices that are being impacted. So we are poorer, and there is no way out of that. The trade-off is much worse.
Hi, Governor. David Chow from ABC News. So with each successive interest rate hike comes the higher risk of a recession. So how will you know if you've gone too far?
So I don't know what specifically what definition of recession that you're referring to, but if you look at our forecasts, you'll see that we have growth going down to about 1.3%. That is pretty anaemic growth. So I would say that in those circumstances where, it's not a great outcome for Australia, but as I said earlier, we've had this shock which has lowered our real income. So yes, we are all feeling poorer. That's what this has done, this war on the other side of the world. Yes, it's possible that we have given too much weight to the inflationary risks and we haven't given enough weight to the possibility that consumption will pull back quite a lot. At the moment, we think in our baseline scenario that that's not going to happen, that growth is going to be anaemic, but the economy will still grow, but there's always that risk. So we'll be doing what we always do, which is we'll be looking at the forward indicators to the extent we've got them, our liaison programs, our surveys, and the hard data, so we know where we're standing at the moment, and we'll be making assessments. And if things change, we will change.